Investment Landscape. Welcome to Chapter 1, The Investment Landscape. This module provides a foundational understanding of investment planning, focusing on the investor's perspective, available asset classes, inherent risks, and effective decision-making frameworks. We begin with the most crucial element, the investor's purpose. Investors and their financial goals. All investment planning must start with the investor's purpose, the why, rather than simply focusing on the financial product. We achieve financial goals by clearly identifying future financial events and assigning priorities to them. Importantly, remember that events with negative potential outcomes, like accidents or theft, should be covered by insurance policies, not investment capital. Crucially, avoid the pool approach to ensure you know the specific investment horizon for each goal. Savings versus investments. Saving and investing are sequential steps. Saving emphasizes the safety of money and is fundamentally about reducing consumption. Investing, on the other hand, aims primarily to earn profits, embodying the fundamental trade-off between risk and return. All investments must be evaluated based on three primary factors: safety, liquidity, and potential returns. Asset classes. Investment avenues are grouped into four broad asset categories, each with distinct characteristics. Real estate is illiquid and provides rent and appreciation. Commodities, such as gold and silver, do not generate current income. Fixed income involves lending money and generally offers predictable interest. Finally, equity represents ownership capital, considered risk capital, that offers high growth potential over long periods. Asset comparison table. This table summarizes the core differences. Note that fixed income is characterized as a lending asset with agreed upon receipts, while equity, real estate, and commodities are ownership assets with highly uncertain future cash flows. Investment risks. To properly evaluate any investment, you must understand the associated risks. Inflation risk decreases purchasing power, forcing us to calculate the real rate of return. Liquidity risk is the difficulty of selling quickly without loss. Credit risk is the risk of an issuer defaulting on a debt instrument. And finally, market risk is the systemic risk that impacts all stocks and cannot be diversified away. Risk management strategies. There are three key strategies for managing investment risks. Avoidance means not investing in things you don't understand. Taking a position involves dynamically adjusting the portfolio based on market anticipation, a high-risk strategy. The most prudent approach for lay investors is diversification, spreading risk across various options to reduce the chance of losing everything. Behavioral biases in decision-making. Investors often make irrational decisions driven by emotions and biases, introducing risk unrelated to the investment itself. Examples include the herd mentality, where investors follow the crowd, loss aversion, preferring to avoid a loss over acquiring an equivalent gain, and confirmation bias, which causes investors to miss new risks that challenge their existing beliefs. Asset allocation. Asset allocation is the process of distributing your money across asset categories based on your objectives. Strategic allocation involves maintaining a long-term target aligned with your goals and risk profile. Tactical allocation involves dynamically changing targets to capitalize on short-term market opportunities. Rebalancing is the necessary act of modifying the allocation periodically to restore the portfolio back to its strategic target. Risk profiling and measures. Risk profiling assesses the investor's risk appetite through a triad: the need to take risks, the financial ability to take risks, and the psychological willingness to take risks. For measurable risks, we use variance and standard deviation for price volatility, credit ratings for credit risk, and modified duration for interest rate risk. DIY versus professional help. The final choice is between managing investments yourself or outsourcing the task. Use the decision framework of capability, willingness, and affordability. For most investors, a mutual fund is the superior outsourced option, professionally managed by an asset management company, which helps mitigate the hidden costs and emotional errors of DIY investing. Conclusion. In summary, the primary role of investing is to accumulate your savings and grow them through appropriate investment avenues. Thank you.